All right. Hello, everybody. Good morning. Welcome to the show where I, Michael Duke, take a look at stocks that are interesting. So, if you find that interesting, please consider liking this video and subscribing to the channel so you see more. Today, we're going to be talking about ZTS, Zoetis. I'm not sure if I'm pronouncing that right. I have pronounced company names wrong before, like Corteva, otherwise correctly known as Corteva. Anyways, if I got the pronunciation wrong on that, don't fault me. I'm just going right from the top here, right from the top. Super interesting company. Okay. In the pharmaceutical industry, particularly, well, specifically animal pharmaceuticals, both pets and livestock. As always, I'm going to be giving an overview of the company, what they do. We're going to take a look at the numbers, the valuation, the dividend. We're going to discuss the risk factors. We're going to do a technical analysis. And finally, I'll conclude with a grade buy, sell, or hold. As always, this is not financial advice, merely my opinion. All right, let's get into it. First off, I just want to qualify by saying that I really do not like investing in pharmaceutical companies. They're at the very, very bottom of things that I don't like to touch. Um, I'll invest in coal before I invest in pharmaceuticals. I've got my reasons for that. I'll just decline to elaborate on that for now because it's not really relevant. This company, though, the fact that it's animal pharmaceuticals, that checks a box for me that makes it investable. And there's a lot of reasons for that. I think you have the ultimate pay structure of a pharmaceutical company that sells to animals is a lot more investable to me than human pharmaceuticals, uh, where really insurance is ultimately footing the bill for a lot of that kind of stuff. I think it's just a completely different economic type of structure. So I've been watching this one for a long time. Um, Never really dove deep into it until recently because it has gotten absolutely crushed in the last year. I mean, you can see if we just zoom back out, maybe I should zoom in here. If we just zoom back out to the all time chart since 2013, I believe this company used to be a part of Pfizer and it is, now standalone. But went from 31 a share all the way up to mid 200s. So we 8x'd in less than 10 years. Just a phenomenal, phenomenal compounder machine. And then in the last five, off that high, we are roughly a third of the price that of the all-time high price right now, less than a third. So what's going on? What's going on here? I mean, this again, and how about this chart? Just flat, boom, boom, flat, boom, flat. What a chart. What a chart. Super interesting. So let's take a look. And in this video, because I don't have a ton of knowledge on healthcare, pharmaceuticals, and all that, I'm going to lean heavily on, all the materials that I have access to today to really help me get through this overview part. But let's start with the summary. Zoetis Inc. engages in the discovery, development, manufacture, and commercialization of medicines, vaccines, diagnostic products, and services, biodevices, genetic tests, and precision animal health solutions for the animal health industry in the United States and internationally. Company commercializes products primarily across companion animals comprising dogs, cats, horses, and species, including livestock such as cattle, swine, poultry, fish, and sheep. It also offers parasiticides, vaccines, dermatology, anti infectives, pain and sedation, other pharmaceutical and animal health diagnostics. So we have pharmaceutical drugs and we have medical devices. Interesting, right? It's incorporated in 2012, headquartered in Parsippany, New Jersey. I'm gonna let's just take a look at the Morningstar report because, frankly, these analysts are much higher paid than I am, and they live in. I give a high level view on all sorts of different companies all the time. The way that these analysts work is they're assigned a set of companies and they just dive in deep and review them over and over and over again. Okay. Just to give a little bit more background into the company, this is Debbie Wang, Senior Equity Analyst at Morningstar, writing on the 18th of May. Zoetis is the undisputed leader in the global animal health industry, and we believe it possesses the widest moat of all the competitors. The animal health industry had long been largely ignored because these businesses were buried within larger human health companies, but no longer. So, in other words, it is a pure play animal pharmaceutical company. Okay. It has many attractive characteristics, including cash pay buyers, a fragmented customer base, relatively low development costs, and opportunities to introduce novel therapies. Because of the fragmented and cash pay customer base, that's kind of what I was alluding to earlier, animal drug makers hold significant pricing power. Okay, yada, yada, yada. Zoetis has benefited from pet owners' increasingly strong relationships, which drastically increases their willingness to pay for expensive treatments. Think about all the times you've heard about a pet getting into health trouble and the cost that it is to fix that problem and people's willingness to pay, right? However, heightened competition from Elanco and Merck has entered the picture, which we think can eat into Zoetis' key parasiticide and dermatology franchises. This puts more pressure on the firm to develop and launch innovative therapies, which has been one of the firm's strengths. Right here, I was reading this a few minutes ago. There's a right here, big picture. For a firm that has rarely made a misstep, it's become clear this quarter that Zoetis doesn't seem to have appropriately prepared for the kind of competition Elanco and Merck are ready to engage in. Okay. So, my read on that is this company was the only game in town here. Was the only game in town. And then new players, well capitalized, large players, incumbents in other pharmaceuticals, spent some money on developing some drugs, and that's eaten into market share. So I think the question we're trying to answer here is the stock undervalued now, given the fact that it's been significantly repriced and that presumably the franchise isn't as dominant as it was before? Morningstar certainly thinks so. One thing to note here, though, and if you've never looked at a Morningstar report, the black bars here represent basically the price target, the fair value estimate, and then the rating is relative to where the current price is to the fair value estimate. You see here, Right now it's a 4 out of 5, but really up until this date, the 7th of August, a week ago today, it was at a 5-star. And the kicker is here. We've lowered our fair value estimate to 102 per share, down from 140, after assuming the companion animal segment declines 8.5% in 2026, another 4% in 2027, before returning to positive low single-digit growth in 2027. Okay, so they've really slashed. I mean, over here, fair value is 188. Now we're at 102. So the market has certainly priced in a new normal for the company, and so have some of the analysts. Again, this is just one analyst, this is just one report, but helpful for us to understand the overview of what they're creating. Okay. So let's take a look at the most recent earnings call. Okay. Sorry, my camera cut out for some reason when I slid to this the last time, but let's get into it. Okay, so this was 8 days ago. This is the insights here on Seeking Alpha of the earnings call. Okay. Okay, so just gonna breeze through this here. CEO Kristen Peck said results, quote, fell short of our expectations as veterinary clinic visits declined across markets. Pet owners became, quote, more selective, and competition shifted towards higher levels of discounting, rebates, cross portfolio bundling, and other incentives. Peck highlighted a split performance. Revenue grew 6% internationally, while the US declined 7%, with livestock delivering another quarter of strong 11% revenue growth, more than offset by companion animal declined 6%. So, companion animal meaning pet. I believe that's the larger segment than livestock. It's interesting. There's some leadership changes. Okay, CFO comments. Second quarter global revenue was $2.5 billion, flat on a reported basis and down 1% on an organic operational basis. Management cut guidance, with Peck saying we now expect organic operational revenue growth to decline 3 to 1% and organic operational growth to decline 9 to 5% in adjusted net income. That doesn't sound very good. The CFO set updated guidance 9.12 to 9.32 billion in revenue, adjusted net income 2.57 to 2.62 billion, adjusted diluted EPS 6.15 to 6.25, reported diluted earnings per share 5.55 to 5.65. Adding that July trends have not yet indicated market stabilization. So don't expect better results next quarter or us to come up on guidance again. Joseph framed the guide scenarios. The high end assumes contained competitive and pricing pressures, manageable share losses, dermatology, and parasiticides, while the low end reflects competitive and pricing pressures accelerate. July weakness carried through the second half. So, just like in the Morningstar report here, it's become clear this quarter that Zoetis doesn't seem to have appropriately prepared for the kind of competition Elanco and Merck are ready to engage in. This is what they're going off of. And then you see here, global companion animal down 6%, key dermatology down 16%. Companion animal diagnostics up 12%. However, you see that's only 118 million versus the 1.7 billion in pharmaceuticals, right? Of companion animal. Companion animal diagnostic, oh, we just said that. And livestock, 731 million, up 11%. US dermatology remained the clear market leader with approximately 86% of in-clinic share in quarter two, despite share declining 5 points sequentially and 10 points year over year. Okay, that's pretty severe. While Simparica Trio held in-clinic market share of approximately 21%. Yeah, I mean, not good numbers, right? Adjusted gross margin 73%. Super, super, super good margins. And I think we'll just leave it at that in terms of this insights doc here. Let's take a look at the company prepared presentation for that. Again, you see net income was down, but earnings per share up. Oh, and actually, let me go back to this. Earnings per share were up, net income was down, and that is because, where did I just see that? He talked about buybacks. Where did I see that? Right here. We repurchased over 550 million of shares in the quarter, which he called a deliberate and attractive use of capital at our current valuation. 550 million of shares. So that's where the earnings per share growth is coming from. It's coming from buybacks. Okay. That's a $31 billion market cap, $550 million of shares. That's almost 2%. Okay. It's pretty strong. So earnings per share continues to grow, and presumably earnings per share will do so, continue to outpace any sort of losses, not losses, but declines in income in the subsequent quarters. This kind of gives you an idea. Here's what the actual brand names of the treatments are, and the revenue, dermatology. Okay, so I do want to talk about this for a second because there's some news on this that just came out. Simparica Trio continues to redefine the standard of care, remains the leading canine parasiticide. We had a modicum of revenue growth there. Again, this is canine. Well, interestingly, yesterday news came out that the FDA granted emergency use authorization for that treatment, Simparica Trio, for New World screwworm. Of course, New World screwworm is livestock, a pest that infects livestock, particularly beef. It's been found in Texas and New Mexico, but definitely in Mexico. The drug is already approved for treating heartworm, ticks, and fleas. So that's interesting. So if you're looking to keep your eye on something, maybe keep your eye on this in the upcoming quarters. Companion animal diagnostics, medical devices, looking good. But again, this revenue is kind of a drop in the bucket compared to these other franchises. And then here's our livestock. That was a bright spot. Advances in innovation. For the sake of time, I'm not going to get too into this. However, The company here is talking about some of the drugs that are in the pipeline. These are the total addressable markets here. And, just gives you an idea of this company has built their business on innovation. It's another reason why I don't love pharmaceutical companies. They have to constantly be creating new things, new products, um, to be able to penetrate new markets and grow revenue. So your long-term outlook is, somewhat driven by continued renewal of, better and better drugs. But all in all, I'm not knowledgeable about these types of matters, so I don't want to lean on this too much, but I would say this looks fairly promising. Let's take a look at the numbers in a more overarching sense. Let's go annual for a second. Remember, 2013 is when we came out. So 4.9 billion of revenue in December 2016, 9.6 over the trailing 12. That's almost a double in revenue. 3.2 billion of gross profit in that time to 6.8 billion. Today, that is more than a double. So our gross margins have expanded over 10 years. Operating income 1.5, rounding up to 3.6, also more than a double. Okay, all that looks phenomenally good. Net income going from 821 million to 2.6, that's more than a triple over that time frame. So the margin outlook over that time has looked phenomenally well. We've also seen the share count from 496 million to 430 million over that time frame. So we've bought back, what is that, 65, 66 million shares, versus a 500 million base. It's quite a bit. So our diluted earnings per share, we've gone from $1.65 a share to $6 a share. That's almost 4 times. Okay. It's almost 4 times. So those numbers are phenomenally strong. If we look at this over the last few quarters, we see, again, June to June to June. So over 2 years, 2.36 billion in quarterly, June 2024 to 2.47. Okay. So that's, what is that? 107 million of growth over that time, top line. Gross profit, 105 million. So almost all of that proportionately has flowed through to gross profit. But gross profit appears to be relatively, the margins look to be flat. I'm trying to do that math in my head. I think we're going to have to look at the chart. Operating income has also gone up 100 million in that time. Interestingly, we have retired about 38 million shares off of a 455 million base in 2 years. Okay. So we've been retiring about 4% of the shares per year over those 2 years. However, in the most recent quarter, they were able to retire almost 2%. So they're able to retire more shares at these depressed prices. Something very, very interesting. The fact that they continue to plow money into buybacks gives you an idea of management's confidence. Another thing I wanted to address is just take a look at the insider selling and buying here. A couple of the independent directors here within the last quarter, about a quarter ago, bought quite a bit of shares. We see here Mr. Frank D. Emilio, 6,600 shares, right around the current price for $500,000. Basically sized up his position by a third. Pretty big insider buys here. Okay. Almost $1 million there. Notably, the CEO has not purchased shares. I don't try to put too much stock in insider selling and buying because, frankly, there's often a lot more selling than buying that goes on, regardless of the company. However, it's always good to see insider buying. So I think that's interesting. I do want to put the margins on a chart. What competition means to me is margins coming down. Okay. And they said that in their report that market share is coming down. So I think it's important that we just visualize our margins here. And really, over the last few quarters, margins have ticked down somewhat, but really not a lot. Gross margins of low 70s% continue to be exceptionally strong. So as of now, margin compression has not shown up in the results. Only top and bottom line numbers, and we know that that's true by when we looked at the financials. Pretty much all of that revenue growth was flowing through to the bottom line, both on a gross and net basis. These are phenomenally strong margins. Okay. So ultimately, despite the fact that you've got this pressure going on, this competitive pressure, I think that these margins look really good. The underlying quality of the business still appears to be strong. And they're saying what was it they said they had like 86% market share in companion animals or something, down from basically a monopoly on it. Okay. But they still are indisputably the market leader with those numbers. So let's take a look at the valuation now in several metrics. Forward price earnings, 12. Okay. Right off the bat, seems like a deal, right? Without knowing anything else. Okay. So on a trailing basis, we're less than 12. 5-year average of over 30 times earnings. On a forward basis, non-GAAP, those are both non-GAAP, 12 times versus, again, 30. And then on a GAAP basis, we're, 12, 13-ish, also in the 30s. Price earnings growth ratio, despite the fact we have lower earnings growth, price earning gap ratio has come down from elevated. In fact, if you look at every single one of these difference to 5-year averages, we are over 50% in every metric except for the, large price book. I wouldn't expect a company like this to have a low price book ratio. I wouldn't even put stock in price book for a pharmaceutical company because the assets are basically intangible. Price sales were at 3 something times versus 9 historically. Enterprise value EBITDA and EBIT around 10 versus in the low to mid 20s. Price cash flow 11 times versus 28. And then how about this dividend yield? Look at this. Over the last 10 years, the yield hovered around 50 basis points and is now almost 3%. Okay. Just unprecedented levels of yield. I mean, even the free cash flow yield, 7%. free cash flow yields, earnings yield 7, 8.5%, operating earnings, double digit yields. Okay. So I understand why the stock has sold off so much, but the valuation looks incredibly appetizing to me. Okay. Incredibly appetizing. Earlier this year, they raised the dividend by 6%. And that is, off of a track record where they've been raising the dividend again, growth rate over 10 years compounded, almost 20%, 5 years, 17%, 3 years, 13%. So we've really come down quite a bit from where we were at. Again, makes sense. I would expect more muted dividend growth going forward. But if they're going to continue to buy back shares, they're going to continue to raise the dividend. I would be surprised if they just didn't raise it here. Because if we look at the payout ratio, we've hovered along that 30% range the whole time per share, right? So I think that, all throughout history, as far back as we can see in this chart, this has been a dividend growth stock, really just a growth stock with a very, very menial, almost inconsequential dividend yield. And now it is full blown dividend screamer yield status. So the valuation looks severely depressed to me. The financials, again, we've got headwinds clearly. We've got lots of weakness. We've got lots of weakness. Again, livestock is a bright spot, but we are just nowhere near, companion animal is 5 times the size of livestock in the United States. Companion and livestock continue to, they're more in line with each other internationally. International numbers look healthy. United States doesn't. That's interesting, right? Gives you an idea of their reach. So ultimately, I think that the valuation, Seeking Alpha is giving this a B minus. I would say it's more palatable than that. It looks like a really, really strong valuation. Again, 12 times forward earnings. Gives you an idea of the kind of yield that you're buying this at today's price. I'm not going to discuss the moat as much. Again, we kind of leaned on this. Morningstar, Debbie Wang says, we believe it possesses the widest moat of all the competitors. I think that's just a function of market share at this point. Okay. So I think what we should expect here in the go forward is that, I don't see this business as being impaired. It just was trading at a really, really frothy valuation. Again, these are 5-year averages, right? Yeah, 5-year averages. Okay. 5-year averages, this is the 5-year chart. Okay. So where we're at now, I think it looks like a deal valuation wise. I think the financials look fine. I don't know enough about this industry to be able to speculate if it's significantly impaired or not compared to the competitors. But again, we're talking about these product lines have significant market share as of now. Even if the new treatments, the new drugs, whatever, come and take significant market share, we're still going to have significant market share, and clearly this company is generating phenomenal returns on capital. In fact, let's look at those metrics here. Return on equity, 65%. Return on assets, 17.5%. So we have an insane margin profile and level of profitability here. Before we forget, let's look at the balance sheet. So we got 1.5 billion of cash. That's more or less in line with where they've been over the last several years. Receivables, 1.5 billion of that, and 2.5 billion of inventory. So 6.3 billion of current assets. They've got quite a bit of property, 7 billion gross, 4 billion net of depreciation. Quite a bit of goodwill. So they've made some acquisitions. Okay, but if we just look at their current assets versus current liabilities, there's no short-term debt. There's no current portion of the long-term debt. Payables and accrued expenses, 1.5 billion. They have enough cash to effectively be able to pay all of their current liabilities. 9 billion of long-term debt. You see how that's really ballooned lately. So they don't have enough, they're not net cash, but retained earnings continue to trend up. So between the buybacks and the dividends, we're definitely not returning too much capital here or taking on too much debt. Retained earnings continue to trend up. In fact, $4 billion over the last 2.5 years here of cumulative retained earnings that have been sequentially added on. Again, we know book value, not great. Maybe they've taken some write downs on some of their intangibles. I don't know. Cash per share, 3.56. Dividend rate, 2.12 per share. They have enough cash to pay all their dividends for the next year and a half if nothing else works. Of course, that's very, very crude way to analyze it, but I think the balance sheet looks fine. It's not the best balance sheet I've looked at, but it's fairly healthy. And they've got plenty of liquidity relative to their current liabilities. So that checks the box too. Okay. So let's discuss some of the risk factors. I mean, I think those should be pretty clear. They're just facing downward pressure in some of their crown jewels here. Downward pressure. There really is no indicator that trend won't continue indefinitely, right? So we're going to continue to see kind of muted top line growth, I think, in their biggest segments. That's something that could keep the shares, at a really what I believe to be a meanable valuation for a while. If we're looking for a quick catalyst here that's going to skyrocket the price back to where it was, I don't know if we see that. But certainly this business is higher quality than what it's priced at now, I guess is kind of what my mind is screaming at me. But really that's a risk, is like you see the price, you're like, man, that's sold off a lot. It hasn't bounced in a dead cat sort of way. It hasn't bounced back every time it's fallen. It's just stayed flat, fallen some more. Now, I will say these results that they released August 6th, the stock really didn't sell off or go up on those news. So really all of the worst news in that earnings report was largely priced in already. Okay. So yeah, I think the risk is just that we don't just rebound here. And I think that's a pretty palatable risk reward, because we're looking at, if they're able to develop new treatments and capture a majority of the market share there, then That's some upside. And then, they've been very, very harsh with their revised guidance. So any outperformance of that is going to push the stock up. So I think the risks are pretty straightforward. It's just it's the risks are priced in. The risks are known in terms of they've been losing market share at some of their crown jewel markets, and presumably that trend will continue into the near future. But we're not talking about the amount of profit potential that they have just falling off of a cliff. I think what we're talking about is more of a slow bleed into a new normal. So presumably this company won't just reverberate back to a 30x price earnings, but will it normalize to something a little bit closer to 20? I think is the question. As they return to growth, maybe get some new products out there and innovate into a new normal. Um, Ultimately, I like the risk reward here. Let's just do some technical analysis. Um, I mean, look at how ghastly this chart is. I mean, you have to go all the way back to 2019 to be at the price that we're at now. I can't even zoom out far enough to draw a line right there. But that was a level of support that we saw. The price fell quite a bit there, and we're just there's really no analog here. It's hard to draw this chart because we're just in completely new territory. I mean, there is kind of a line right here. I mean, we just fell right through that, right? Really what we're looking at is that all along the way, we've kind of just been holding these levels of support. And now we are in new territory here. It's basically been in a very bearish formation for a while. There's no indicator here of relief other than the fact that we're currently at a level of support. Every time that we've gapped down on really putrid results, we've ended up in a completely new zone. I mean, it's been a while since I've looked at a chart this bad. Pretty hard to do technical analysis here. There's really no it's not on a trend line. It's just on a flat line of support. Oops. Just on a flat line of support. Okay. So again, I think when you're taking into consideration the valuation, when you're taking into consideration the way this chart looks, um, obviously a stock can always fall further from where it is, but I like where we're at now. I think there's more upside than downside here. But circling back to the risk factors, we're talking about a stock that's been extremely volatile. Stocks that are in this type of formation, they can always drop further. I mean, you're basically in the bottom fishing club now. And there's always a heightened level of risk when you're buying a severe drawdown like this. So there's that. I think that's the risk, is just that the sentiment is so dead on this name. It's just so depthly bad. If you're buying shares of this, which, disclosure, I did buy shares of this after taking a look at it. It's probably clear based on the way I'm talking about it that I like it. But if you're buying shares in a company like this, you have to expect it to be volatile in the short term. It's not an investment that's safe in terms of the daily volatility, the daily movements of the stock. We even see that down almost 2% today. volatility is to be expected indefinitely until they're able to buck the trend somehow. How they get out of that, I don't know. But valuation is palatable. So I think we've said enough. I think it's clear where we're at. I grade this a buy. It looks like a really good deal. It looks uh, all the valuation metrics just scream value to me. You've got really strong yields both on a cash basis in terms of the dividend and in terms of the underlying earnings yield. And even if earnings on a cash basis continue to be flat or decline, then the presumably the company is going to continue to buy back shares and therefore increase the dividend even in light of less cash flow, or at least keep it flat. So I think if you're a dividend investor, there's plenty of coverage here. If you're a value investor, there's plenty of coverage here. If you're a growth investor, you might have used to like this stock and now you don't. This is probably not the right investment for you if you're a growth person. But for value and dividends, I think it's definitely a buy, and I think it's a tantalizing prospect. As always, conduct your own research. We didn't dive super deep into the market dynamics here, which obviously are important. So I urge you to do your own research when it comes to that. I'm looking at a lot of historical data, which we know that the go for stocks are forward looking, and a lot of the go forward is murky. However, I still like the risk reward here. So I'm going to grade it a buy. And yeah, I think that'll conclude our video today. So hopefully you found this interesting. If you found it insightful and you want to see more, consider liking and subscribing to the channel. I'm always doing videos like this. I've really fell off the wagon the first half of the year, been busy with other projects, but I'm back in the saddle now doing more of these videos. Also, be sure to follow me on Seeking Alpha. I'll put the link in the description. If you haven't, I write detailed write-ups of everything I analyze on there, and it gives a little bit more well-articulated view of what I'm talking about, so you don't have to listen to an hour of me in front of a camera if you would prefer to read. But anyways, hopefully you found this interesting. I appreciate you for watching, getting to this point, and always appreciate my viewers. Leave a comment, let me know how I'm doing, giving me a suggestion for something else to take a look at. And yeah, that'll do us until next time. And I will see you guys soon. Thanks for watching and have a good rest of your day.